Welcome all. Welcome as you get settled here into this session. We are we're going to be getting started in just a sec, but do us a favor. We always love to see who's joining us on our live sessions, whether we're doing podcast live sessions, whether we're doing webinar live sessions. Get yourself into the chat. Get your typing fingers ready. Let us know, whereabouts you're coming from. You're coming from Toronto, you're coming from somewhere else in Ontario, you're coming from, West Coast, you're coming from the East Coast. Let us know. We could have lots of folks from all over Canada joining us here today. So let us know that. Also, let us know, what's your job title? Like you have a business. Let us know a little bit about a little bit about yourselves. Feel free to get in the chat. Feel free to turn on your cameras as well. We'd love to see those faces join us. We're going to make this an intimate session. We're going to make sure that this is impactful for you. That we're going to be, let's just get right into it. We're going to be talking about strategically unlocking and investing your retained earnings. Your host today, myself, John Orr, Kyle Pierce is right underneath me, but maybe not for you. But we are the hosts of the Canadian Wealth Secrets podcast. Kyle is the president of corporate wealth management here at Canadian Wealth Secrets. I am the chief operating officer at Canadian Wealth Secrets. We have our two special guests here. We have Sarman Boyajian and we have Ara Saakian. They are here from PE Gate, and we are super excited to welcome them. Sarman and Ara are both partners at PE Gate, which is a firm dedicated to democratizing private equity by offering accredited investors fractional ownership in private businesses and secondary markets to trade their shares. Gentlemen, let's get into it. We're going to be kind of unpacking these strategies we want to talk about today. Just as a reminder, before we get going, the content we are going to share here today is for entertainment, informational purposes only. It's just not financial advice. We always also like to start off our sessions with what you're going to learn. And specifically, we're going to unpack how to access and invest your corporation's retained earnings without triggering personal tax liabilities. We're also going to be talking about how to use those assets to fuel long-term tax-efficient growth. And we're ready to get into it. We introduced a little bit about us. You're introducing a little bit about you in the chat. But let's kick things off. Kyle, I'm going to turn it over to you because since we're talking about retained earnings and we're talking about kind of optimizing retained earnings strategically, why is that such a problem for business owners right now?
John, this is one of the biggest challenges. And you and I actually were on this journey for many, many years. And ultimately, at the end of the day, people eventually start to recognize, especially when they're earning active income inside of a corporate structure, that those dollars are taxed favorably only until you remove them and start to spend them in your personal name. And this can be problematic, especially when people are trying to figure out, how do I grow and compound my wealth along the way? So today we want to really give you an opportunity, whether you're an incorporated business owner or not. We're going to be introducing two wonderful gentlemen here who are going to essentially give you a little bit of a sneak peek into the private equity space and how they are helping more Canadians have access to private equity investments. And we're going to sprinkle on some of the benefits to investing in those assets, both either in your corporation or personally. So that's where, for some of our unregistered, our unincorporated business owners or T4 employees will still gain some benefit from this particular webinar here today. So first and foremost, I want to dig in a little bit here with our gentlemen. And first of all, introduce yourselves, guys. I would love to hear a little bit of your story. What got you down the private equity sort of pathway? And what is it that, you're hoping to help other incorporated business owners as well as T4 employees, high net worth T4 employees, invest in the private equity space?
Well, thank you for having us. We've been following you for quite some time, and we're glad. It was difficult to get on this, but I think there's a great fit with what you guys do and what we offer. While we started this, my whole career has been around private equity, and I realized it's really reserved for ultra high net worth people. And a lot of friends would come to me and say, how can I access private investments? answer is unless you have 10 million and you could write $1 million check, you really can't. So that's when we started on the journey to democratize private equity and bring those deals to accredited investors. And also, we saw the gap, and many private equity funds are targeting larger businesses. No one's really targeting the 1 to 2 million EBITDA business. And from experience, those are especially the ones owned by older, experienced entrepreneurs. They're looking to retire, so they're not really putting the effort in to grow, which gives a lot of opportunity to grow. And when you're buying those businesses at 3 to 4 times EBITDA, you're going to get a decent return, even if you don't significantly grow those businesses. So that's why we created PE Game.
And I think something to add, Ara, is that difference that you saw where you're working is the larger funds versus smaller funds, right? Is really being able to tap into that untapped kind of business.
Absolutely. So it's easier to do a bigger, it's hard to do a big deal than a small deal. It's just the same amount of work. We're actually closing a deal today, hopefully, after a very long 4 months. And that's why the larger funds prefer larger deals. It's just less work, but then you have less opportunity to add value to those transactions. So you're really relying on financial reengineering. And there's other reasons why, there is benefit of what we do. We're not a fund. This allows investors to choose what they want to be in versus they're writing a check to a fund and letting the fund manager decide. Generally, that's a good idea. Private equity does fairly well. It's one of the better asset classes, the best. But there's no autonomy. So a lot of people we talk to want to decide what to invest in and when to exit. And that's something we solve. And I think we see a question about liquidity. Someone just asked the question, how liquid is your fund?
Yeah, certainly. It's a great question. And I think that's a massive pain point in private equity, whether you're paying fees or can't even exit altogether. Our goal really is to democratize, as John mentioned, right? So one is to provide access, and two is to address the pain point of liquidity. So with the secondary market that we launched last year, it really depends on each investor's time horizon on when they want to sell. Of course, we're not the buyers. There would need to be another investor on the other side of it. But the liquidity is purely dependent on the OSC regulation of a minimum hold period, and then you finding the right buyer based on the price that you set.
And we've had trades. So the liquidity, we've had trades in our investments. And one was a significant trade. An employee basically bought out an investor fully, and their return on that investment, they cashed out at approximately 45% IRR, which is a fantastic return. And this gave the employee opportunity to own a significant part of the business.
Which we find very, as we speak to a lot of boomers that are looking to retire, there's a right-hand person that has been working for them for many years. And we like to partner with those people who have been there for many years and incentivize them, not as an employee, but to think like an actual owner. And so we facilitate that. And that's what Ara was mentioning. We've done that in the past, and it's worked well to really move the mindset of an employee to an owner.
Love it. Love it. So it sounds to me like there is liquidity and opportunity here. However, this isn't going to be anywhere near as liquid as, say, publicly traded, assets, right? Of course, right? You can't be in and out and those sorts of things. So technically, when you're coming to the private equity space, typically you're looking for, we'll call it a medium or longer term hold. This isn't going to be anything short term. However, it's possible, as we're hearing here, right? There could be someone who has interest in that asset, and they do want to get in through your platform, which I think is quite nice. The other aspect that really intrigues me about what you guys are doing is that exactly what you're investing in. It's not money going into a fund and then the fund is allocating it across several different deals, and the results will be what they will be down the road. Really do own a portion of that company. Can you speak to how do you typically set up each business in its own structure so that someone actually owns shares in that particular company And what does that look like and sound like?
No,
Ara
great
went
question.
through a very
Yeah.
fun process, so I'll let him talk to that.
No, we spent a lot of time in structuring this. We've had our wonderful lawyers review it from a tax structure as well. And what we wanted to do, instead of going with a typical GPLP, the partnership agreement that typically you see with funds, we went with corps so that you're investing in a corp, people understand shares a little bit more, and it mimics the fund structure, but we think it's a lot cleaner. Because really, a partnership you should use when a real estate transaction, for example, where you're going to incur cost losses and you want to hand over those losses in the first few years to the investors because it goes to them personally or to their core. We're not investing in loss making, we're investing in cash flowing businesses. So there was no good reason for us to structure it in a partnership style you would see in a fund. So it's a pure corp. Each opco, operating company, has its own corp, as you can see on the right on this chart. So you're investing directly in a holding company, which holds only that asset, that opco asset.
Got it.
And if you have that's where the timing comes in. If you want to use your lifetime capital gains exemption, not many people know about this. I'm sure you talk about it, Kyle. But each Canadian has 1.25 million in lifetime capital gains they could pay very little tax on, close to 0%, if they invest in a private business. Real estate doesn't count. So this way, if you hold within our HoldCo for 2 years, you are eligible for that lifetime capital gains as well. And that's why you could trade as well. In the fund, it's hard to value all the businesses. For us, it's easier to value individual opcos because you see the cash flow, you see the dividend yield. We did have an exit of an investor after 1 year. He wasn't thrilled about a 15% return. That was the dividend yield on the investment. and he expected stronger growth. Others didn't. So other shareholders. So first you have to offer it to your peer shareholders. And then if they don't take it fully, then it goes to the market, to other investors. And we've designed it in a way so that when you offer it to other shareholders, they could have fractional ownership because they may not be able to write a $100,000 check, for example, but they could write 10,000. But then when it goes to the outside shareholder, it's like eBay bidding. The highest bidder basically wins.
Yeah.
Now, I do want to get into some of the tax advantages of how you've structured this in this very specific way, because I think there's some great advantages here as an asset class in what you're trying to do. But talk to us about the asset class itself, because I think when, if I'm a business owner, I'm an entrepreneur, I'm an investor, and I want to get into, obviously I'm trying to invest for my future or my business's future, or I'm trying to grow my net worth. And I haven't, say, explored private equity, but then I hear the words private equity and it scares me, right? It's like, it sounds riskier than what you're investing in, say, the public markets. So talk to us about, like you said, like the best asset class, like you were considering it the best asset class. Talk to us about that, like the asset class itself, because I think when you think about investing in private businesses, it sounds riskier than everything else.
And it is. So let me caveat that it's the best asset class for me. I like to be on top of my investments. With our investments, you could impact change. So I've owned businesses throughout my life. I've bought over a failing business, turned it around, and I prefer it personally over the markets because I have zero control over the markets.
Right.
I'm not good at. Let's just be clear with that. But I'm very good with private investments. I know we could impact change from people, technology, and so on. So I feel personally more
Right from there.
than.
One thing to add there, John, if we go back one slide, this is chart at the bottom right really just shows you risk adjusted, which is always important to when you're looking at returns, you also need to take into consideration risk that you're taking on, right? So you've got volatility on the x-axis and you've got returns on the y-axis, right? So ideally, you're at the top left of that, right? So if you look at private equity over 30 years, it's outperformed any other asset class on a risk-adjusted basis, right? So you have high returns and less volatility than stocks. And that's something that, on Liberation Day, when Trump came out and, just slapped a bunch of tariffs,
Yeah.
you see Meta, you see Google, you see Nvidia
Yeah.
dropping 20, 30%,
Right.
right? So nothing changed about the company, right? We don't even know what's happening, but yet everyone gets scared and people start selling,
True.
panic selling, right? So when it comes to private businesses, they're sheltered from the markets, insanity of just wanting to sell
Right.
for emotional reasons, right? So to add to Ara's comment that it's a business where you can implement change and take control, you're also shielded from irrational selling behavior due
Right.
to whatever, a president says. So that's an interesting one. And then if you look at the chart at the top, going back to private equity as an asset class, a lot of people hear about it, right? A lot of people know stocks, they know bonds, of course, they know crypto because it's readily accessible to everybody. But not everyone has access to private equity. The people who do, as Ara mentioned, high net worth individuals, family offices, endowments, pension plans, and it's no surprise why, pension plans and endowments such as Harvard allocate up to 50% to private equity. So it's kind of this like old school big boy club because it has great returns,
Right.
but not everyone has that $1 million ticket to write. So
Right.
that's really where this all started, is to say, let's find local Ontario businesses that are great businesses. Owners are looking to retire, right? You have the silver tsunami of many boomers looking to retire, and maybe their spouses, their kids don't want to take over.
Right.
So instead of seeing those businesses close, why don't we incentivize current employees with a stock ownership? We'll help them grow and make those businesses available to other investors with ticket sizes as
Right.
little as 50,000.
Yeah. Yeah. Now, just that first chart that you highlighted about the volatility and the returns for those who are listening and not, say, watching, say, the slides, you've got that stocks being the most volatile because of the examples that you said, and also higher returns than, say, bonds, cash, slightly around real estate level on this. But then you have private equity higher than in returns than everything, but also lower on volatility. So I think you make a great case for that being, say, less risky than investing in the stock market for good reason. Also, that chart is showing 1986 to 2018 historical returns. So there's some good sort of data there to kind of back those pieces up. I would love to kind of dig into, we started this session with promising everybody that we're going to talk about, like, how do we take retained earnings and use them in a tax advantageous way to, and also invest in private equity as an asset class. So talk to us about like how tax efficient some of the structures, like you've carefully crafted your structure to take advantage of some key moves here. So I don't know if
Yes,
Sarman
and
or
I
Aro.
don't think these returns are after tax. So from a tax perspective, we can't see a better asset class because compared to the public markets, if you get a dividend, let's say you invest $100,000, so you get $100,000 back, there's no tax. So because we don't issue a dividend, we classify it as a repayment of capital. You don't even have to disclose that in your tax return. So you get your
Right.
money back
Right.
basically, and then you start getting dividends. So that's when the tax kicks in. So that could be, if it's a leveraged investment, that could be a few years until you're not paying any tax, even if the value goes up because you haven't sold. And then if you are owning it personally and you haven't used your lifetime capital gains exemption, it qualifies for
Right.
that and you pay very little. So tax wise, it is more effective personally. And we could, Sarman can cover at a corporate level as well. For the retained earnings, it's, at a different level.
Well, before we go into the corporate side, because I think that'll be a really, really important one, especially for a lot of our incorporated business owners that are here with us today and those who are listening on the podcast. The part on the lifetime capital gains exemption that I think is really important is that the vast majority of Canadians never utilize the lifetime capital gains exemption, right? And this is even incorporated business owners, right? The vast majority of businesses don't actually sell. And therefore, there's a boatload of people out there that are unable to ever utilize that $1.25 million of essentially tax-free capital gains. And this is giving them an avenue to do so if they choose to invest using personal dollars. Now, that's a nice little segue into those who do own businesses, because some people here might say, I do own a business, and actually, maybe they're going to be reaching out to you two gentlemen because maybe in 5 years they're planning, to sell their business, and maybe this is an opportunity for them. So they might have that in their back pocket, or they might be thinking, the lifetime capital gains exemption, I want to reserve that for my operating business that I now own. However, I've got this boatload of retained earnings that are accumulating inside my corporate structure. Maybe it's inside the operating company. Maybe it's now in a holding company, which is what, most business owners eventually open up over time. When we go and purchase these businesses inside the corporate structure, we have essentially a brand new world opening up to us of possibilities. So Sarman, why don't you, maybe take us through that idea here, and then I'll add a little bit of color as to how this might really dovetail with some of the strategies that we've discussed on Canadian Wealth Secrets in the past.
Yeah, sure, definitely. Thanks, Kyle. So I think the key things, just to lay the groundwork, is there's two sections under the Income Tax Act. So the first one is Section 112, which talks about intercompany dividend deductions, which allows you to essentially not pay dividend in your corporation when you receive a dividend from another Canadian corporation. So that's a benefit of investing through a corporation. And of course, the more money you keep in the corporation, the more you can grow that, right? The next definition is under 186 Part 4, which is whether it defines whether a corporation is connected or not. If you have greater than 10% of voting and market value of that operating company, then you are technically a connected company. And the benefit of owning greater than 10% of voting and market value of a company you're invested in pretty much says that you do not need to pay any tax when you pay yourself personally. So when you take that money out of the HoldCo to yourself personally. So that's what they define as connected if you own greater than 10%. If it's less than or equal to 10%, it's an eligible dividend that's not connected. And while you don't pay taxes on a corporate level under Section 112, you do have to defer taxes under Part 4 of 38%. So technically, you pay taxes. Let's say you receive $100,000 from the OpCo into your HoldCo of $100,000. You would pay $38,000. And for every $1 that you receive, every $1 you get back as a refund for every $3 that you take out. So if you pay $115,000 from your HoldCo to yourself personally, you get that $38,000 back. So it's really just a deferral, which is definitely a benefit of still holding in the corporation. But of course, the Hail Mary here is owning greater than 10% in voting and market value so that you're connected and you don't need to pay corporate tax or any personal tax when you pay a dividend.
Now, as a nuance, I think it's really important for us to clarify here. When we say no personal tax, there'll be no personal tax triggered. However, those dividends are going to go back to whatever corporation is owning the shares in the operating company, correct? So if I want
to clarify, if you invest your retained earnings in another business, an active business, which we offer, and we structure our deals in a way you are getting technically voting. So we allowed, for example, in the latest transaction, 3 corps to invest with us because they needed to have 10.1% each.
Right.
We wanted to maintain 51% control because we need to control that holding company. So when they invest more than 10% and they have a voting right of more than 10%, those two have to take place. then any dividend they receive back in the corp is tax-free. So that's the part that is tax-free. And it has to stay in the corp, obviously. Once you pay personally, then it triggers
Right.
taxation.
So I like to use analogies here to make this super clear. You know, people who are in the room right now, they're going, okay, I personally own my holding company. My holding company owns the shares in, say, my operating company. When your operating company passes a intercompany dividend up to the holding company, there's no tax. However, if I do pay out a dividend from my holding company to me personally, I will have to be taxed at that time. And basically, what we're hearing here is that this is an opportunity for someone like myself who has a holding company, who owns shares in my operating companies. I could actually invest at least 10% of the value in a private equity company that your team has put together, and any dividends that are flowing back to my holding company can do so just like they would from any of my other operating companies. And ultimately, I've got a nice passive income stream that isn't going to trigger any additional taxes to me or my holding company until I choose to, say, take them out as a dividend or a salary down the road at a personal level, which may or may not create more retained earnings problems for us to deal with down the road. But that's where other strategies come into play. And we're able to essentially utilize some great tax planning here while we grow our wealth and keep more of those dollars in our pocket.
And Ara, how do you structure it so that, because it's one thing to invest greater than 10% in value, but you need that voting. How do you deal with that?
Yeah, great point. So because it's a corp and not a partnership, we as PE Gate have special shares, special voting shares.
Okay.
That gives us voting rights, as well as it triggers our carried interest, which is how we get paid basically. So on this transaction, because there was less than 4 corporate investors, we actually gave them access to, they have the special shares that we also hold. But it's meaningless though, because we still maintain the 51%.
So is this common? Like businesses you're investing, like walk us through the structure. Like you're investing in the businesses themselves, and then you're opening up the equity to people, let's say people like us who are going to invest at say 10.1% in that business, and you're retaining ownership so that you can grow. Like, or is it, let's say I'm a business owner and I want to sell some of my equity to other business owners. I reach out to you so that you can help structure that deal. But then how, like, am I retaining all the ownership, or you're buying me out?
So we're in the business of investing in businesses.
Right.
So we wouldn't just let you trade your shares on our platform. So we have to have a meaningful role.
Right.
But it doesn't have to be a meaningful investment. So we've invested minority as well as majority.
Got it.
We've had majority and 100%. So it's whatever makes sense to the seller and not what makes sense to us necessarily. So we have that flexibility, but we do a complete due diligence on the business, and we do a full financial review. We have a very detailed offering memorandum that we prepare, due diligence report. We do quality of earnings, external, if there's leverage involved, like in the deal we're closing. And so you get all of that information in the platform that you log in. There's a technology involved. So we've developed our own platform that, yeah, it's very pretty, we think, but it's functional. So you log in, you see the deal, you commit to the investment, but it's non-binding. You could change your mind at any point. You get the data, you get our reports, and you decide until the last minute, until you fund, whether you're in or not. And so typically we like to be oversubscribed, and we have been on every deal just to there's always someone that can't commit at the last minute. And so once we get those commitments, we set up a holding company. The money goes into the holding company or in trust with our lawyers until the transaction closes. So right now there's money sitting with our lawyers. Once the transaction closes, then it gets released to the seller and basically have control over the holding company, and not necessarily control over the operating company unless we do have more than 51% or have we. And we generally have a new shareholders agreement, even if it's a minority investment. with the founder so that we have a lot of mechanisms to make sure they're on the right track.
This is really interesting, and a piece I really want to drive home here, and it's sort of like a little mini epiphany that I'm having as we're chatting, is around the idea, and we see in the chat a few people were clarifying, like, so wouldn't it be taxed as passive income? And in reality, if you owned more than 10% of those shares, and because you have voting rights, basically what ends up happening is the company itself, the operating company, is going to essentially pay tax at the operating company level, just like you would with your own operating company. And those retained earnings can now pass up to the holding company that you own the shares in tax-free. That money will stay there. And, I've spoken with so many business owners who are looking for better returns than maybe what they've been getting in other assets. So for example, private lending is one that comes up all the time. People are taking their corporate retained earnings and they're utilizing them to give private loans, and they might earn 12% on that. However, that 12% is going to be subject to the passive investment tax rate inside the corporate structure. And therefore, you're going to at least temporarily be paying about 50% until you take out some of those and you get a little bit of the refund, as Sarman had mentioned earlier. So when we compare it to the risk, when you think of the risk profile associated with private lending, and then you look at the risk profile of, say, investing in some of these very well vetted companies, and the fact that you might be getting, say, a 15% dividend, every company and every deal is going to be different. But if you're getting those 15% or 12% or whatever it is, it's flowing back to the holding company without any additional taxes until we take it out at a personal level. And at that point, there are other strategies and structures, which we will get to a little later in today's session, on how we can avoid taking too much out of our corporate structure and triggering, say, too much tax at a personal level.
Like, I don't know if you want to get into that now, Kyle, or do we want to kind of go ahead?
There's a nice question about Dragon's Den. I love being compared to Dragon's Den.
Yeah, I was wondering that too. So I'll read that out loud for the listening audience here. Is in a nutshell, Kurtik says, like, in a nutshell, PE concept here is sort of like Dragon's Den. I mean, would we be like dragons who lend money or invest in other businesses and get a percent return from that business? Am I summarizing this correctly?
And I would argue too, like, you guys even give a bonus if you actually can fire breathe, you actually get more shares in the business. Do you not?
I think there's a lot of similarities. So I think what's important is that we differ from the PE funds, where you are the ultimate decider on which deal you want to invest in. So there's definitely similarities there, right? Like, you get pitched opportunity A, B, C, as and when they're under contract, and then you will decide. As for the returns, I believe a lot of the deals that come on Dragon's Den are pre-cash flow or just break even, whereas we focus dividend yielding, businesses that have weathered many economic cycles, booms, busts. And so those are the types of deals that we like to focus on.
And we'd never get a show at PE Gate because we invest in boring. So Dragon's Den has these exciting new, like, look at this, I'm going to change the world. We don't want to change the world. We just want to make money. So we like boring businesses. Our first investment is in a refractory business, basically laying bricks in industrial kilns. It's doing very well. So we like boring. And it's not, we don't invest in startups and no new ideas. Like, we're not.
This isn't about home runs. It's about it sounds like trying to get the greatest return with the least amount of risk, although there is still risk associated with any business that's out there, but obviously very well vetted and some opportunities. I think I remember you mentioning this in some of our prior conversations, that even without any future growth, you should still be seeing some taking place, because otherwise you're probably not going to be purchasing that business, or you're not going to be going into that business.
Exactly. One investment, for example, we love the investment. We love the team. It's a young, growing team, but it's underperforming, but it's paying a 15% dividend. So, and the risk of that business, it's very hard for it to lose money, but it's it's growing slower than what we'd like, but we're comfortable with it. So that's a type of return. Not but some we in that one, for example, we have a minority interest, so we can't influence growth as much as we'd like when we have control.
I think that's a good segue, Ara, just to share with the listeners, we're not one size fits all where we need to take 100% control and then, do a 180 on the operations. It's really working with the business owner to decide what they want, right? So if we call it flexible exit options, right? So if there's a business owner, in this case, what Ara had mentioned, was not ready to retire, but wanted to take some chips off the table, sell a minority stake, take advantage of lifetime capital gains exemption. We get involved, take a board seat, and we help professionalize and grow the business for a larger exit down the road, right? So not everyone's ready to retire now. It could be a few years down the road, and we're still open to working with those business owners because it's it's areas that we can help and work together on.
Do you want to keep going with some of those examples? I know there's a comment here, but also kind of pairs nicely with sharing examples of like, what does this look like from your end? What does this look like from, say, a Canadian and incorporated investor who's looking to do something with retained earnings and wants to invest. Let's say there's an opportunity, they're like highly interested in it. We know that the 10.1% is going to optimize that part of their tax position to kind of take advantage of the passing of the dividends from the opco up to the holdco at that point. Do you guys want to walk us through like what does this look like for that person, and then what does that look like for you in operating? Like I don't know if you want to use an old example or not an old example, but an example of a business that you've operated but also helped exit.
Yeah. So how does it look like in terms of investment? For the retained earnings, it's just like any other investor. So we would treat them as like any other investor. They'd read the deal files and on behalf of the corp, they'd make the investment. The beauty of this is they can own more than 10.1. And they could own 50% if they want. Should there be room, we try to distribute evenly as much as possible. Like, so if there's interest. But they could technically own 25% and have 10.1% voting just to make it work for us in terms of control. Once they invest, it's just like investing personally. It's no different. You have own shares and you have to trust us to manage that opco, that investment on your behalf.
Right.
And we have a fiduciary duty. I don't know if people know this. There is a difference between US and Canada in terms of the director's duty. So in the US, the board of directors' duty of care is to the investor versus in Canada, it's to the company itself. So we have to do what's best for the business itself. And that means for all shareholders and not just individual ones or for the CEO, for example. So we have a duty of care and you have the right to trade those shares at any point in time, should you want to exit, and you set the price for that. So if you are getting a decent return or not, or you want to exit at the price you invested in, then you could do so. If you want to increase the price, then you can. So it depends on how well that asset is performing.
Now, a quick question that did come up a little earlier in the chat, and I think we couldn't come to it at that time, but there was somebody asking sort of about, like what sort of like costs, like what does it look like closing costs in terms of making an investment, let's say getting into the investment, and then let's say later exiting. Is it straight legals? Are there, what does that look like and sound like? I have a funny feeling it's going to be a little more expensive than Robinhood, right? Where, they throw their trading fees right into the spread. So there's got to be some costs associated with that. What does that look like and sound like, just to give people a sense of what to prepare for?
Yeah, so we're very transparent upfront in our investment memos and offering memorandums. We take a transaction fee to recoup our time finding the deal that we originate, due diligence, etc. That's for P-Gate. On top of that transaction fee, there's of course legal fees, which we believe we have one of the best lawyers at one of the best prices. So we definitely work on keeping prices down. And then we have a operating fee that we charge the business. So this is not to investors, but to the business. And then we have carry. So contrary to typical funds that have a hurdle, we take a straight 20% on any distributions, whether it's return of capital or dividend. And then following that, depending on the deal, the most recent deal that we structured is 40% after 3 times money on invested capital.
But we don't have a management fee. So as you're
Yes.
waiting to invest, there's no commitment fee, there's no management fee, there's no management fee after you invest as well. We only charge a fee if we're involved in operations or one of our partners is involved in operations. And typically we've been well under market. And if we have very little operating role, we take a small board fee to manage the board seat. Again, all that is disclosed in our offering memorandums, and we know what the market charges. We're generally much less than market, and we haven't had any pushback at all, especially from our managing the costs from a legal perspective, because we control and run the deal. We don't get into very expensive legal fees. Now, the trading fee, I think that another question came up. We've taken the hit on all the legal documentation on that. So a complicated deal, which was the employee buyout, would have a higher fee because there's some new structuring involved to make sure it benefits from a tax perspective. But on a trade, we've charged $1,000 each from buyer and seller. So it was only a $2,000 transaction. And that was to cover part of the legal cost for costing.
Right.
I love it. I love it. Now I'm looking at the room. I see right now we've got about 40 people with us, and there's a handful from that I recognize from the Canadian Wealth Secrets community, some of which, I've had calls with, and actually a couple clients that have worked with us on some of their corporate management strategies. And as folks of the podcast would know, we're big fans of utilizing leveraged insurance policies in order to help build and grow wealth. This is one of the secret sauce items that can be added in order to make an investment in private equity, like what you're offering here, something that is supercharged. And by doing so, what we've done is when we take that corporate owned high early cash value life insurance policy, we fund that and then leverage that policy to make the investment into this particular asset, this private equity or this particular operating company. What you're going to get is sort of an extra secret sauce in some of the other strategies. So we do it a lot with real estate. We have people that do it with the public markets and crypto. Well, of course, here, one of the added benefits is that the dollars that are coming back to the holding company are not going to get taxed, as we've heard. And it can then be used to pay down some of the leverage on that policy. So you now have, again, your money working in 2 places at once in the most tax efficient manner. Of course, there was tax to be paid. Let's not kid anyone. The operating company paid tax, but all of that has been factored into the returns. And therefore, that dividend is coming after the operating company has paid its due tax, right? So huge benefit here. There's a handful of you. I'm not going to call you out, but I'm sure there's some light bulbs going off for some of you that have put high early cash value policies in place. For those who haven't, and they're interested in learning more about this and this strategy and how it can fit in, definitely make sure you're reaching out to us over at CanadianWealthSecrets.com/discovery. We'll get you going on both your policy, if that's what you're interested in, or just going straight into learning about some of the current deals. I would love, guys, can you share? I know you've got 3 on the front burner right now. Are you able to share anything about one or more of those current deals? Give them a little bit of a snapshot. And then, of course, you got to leave them with some curiosity so they head back to your platform and they go through and actually dig into the content on their end.
We had a deals talk on our 3 deals just recently, and we're happy to talk about them. I think these are 3 live deals, meaning they're under LOI. We're looking at many other deals, but we only present those that we think are worthy or like are advanced enough and they've passed enough due diligence before we actually expose that to our audience. The one I'd like to talk about, which Simon runs the portfolio, is the pets business, because that's going to be an ongoing raise in terms of, so if you do have retained earnings and you want to write a, say, $150,000 check to get today to get the 10.1%, but you have more to invest, this would be an ideal one because we're going to continuously invest in this sector, and it's in the pet services sector. We've already invested in several businesses, and we're looking at a bolt-on acquisition, which, Simon, if you want to talk about that.
Yeah, thanks, Sarah. We're super bullish on the pet space. Whether you don't have a pet, I'm sure you do, and you probably realize that they spend a lot on those pets. Of course, the demographics have moved to having fewer kids because they're expensive and spending a lot. There's the humanization of pets, and the market size is estimated to double from 150 billion to 30 billion over the next 5 years. So it's a massive market. And our goal really is to consolidate and provide a very professional service across many verticals, where we started off in grooming, and then now we're venturing off into daycare, boarding, and then there's training. There's a lot of places to create that synergy. We now have 6 grooming salons, and we're under contract for Toronto's largest private outdoor dog park. It's on 2 acres of land, and it's going to be where we host our future training sessions, and there's a lot of opportunity to grow and create that value. So this was a lot of the deals that we find are proprietary. Nothing wrong with brokered deals, but we find the deals that you chase and are not available to everyone is really part of our secret sauce. So that is a deal that we're under contract and super excited to bring.
Love it. I love it. There are so many ideas here, I'm sure, that are circling around from the group. And, to be respectful of your time, to be respectful of everyone's time here today, joining us live on the webinar, and those who are listening on the podcast, I think we're going to wrap things up here for today. We'll talk a little bit about some call to action for you. One nuance here, I think the big takeaway that I hope everyone is learning today is, first off, there are other asset classes open and available to you. Private equity is now becoming more democratized through the PE Gate platform. And ultimately, you have access to some pretty efficient tax, when considering this type of investment, whether it's at the personal level or at the corporate level. One nuance I should add here, we didn't get to it today, but some people would say, like, well, where would you invest, Kyle? Like, if I was going to invest in one of these businesses, where am I going to invest from, personally or corporately? And my answer is typically wherever the money is now. So if you have the money personally, it's probably best for you to go ahead and make that investment at a personal level. If that money's in a corporate structure right now, you might be best to do that. However, if you've already got a leveraged insurance policy in place, you might have an opportunity to do both. And we can definitely chat about that on a future discovery call for those who'd like to dig in. Folks, I'm really appreciative of your time here, Sarman and Ara. You'll see on our screen here, and as well on the podcast in the show notes, you'll see some links. Their website is pegate.com or pe-gate.com. Both links should work. And for Canadian Wealth Secrets, of course, you can reach out to us. We're happy to do any introductions along the way over at canadianwealthsecrets.com/discovery. Friends, any final thoughts or takeaways before we call it quits for the day? Maybe I'll flip to Sarman first, and then we'll go to Ara.
Yeah, thanks, Kyle. We've been in the business for 6 years. We've closed 7 transactions with the 8th fingers crossed to date. And, we've all had winners, no losers, and doesn't say that, past performance is a guarantee of future, but, we are proud of our trajectory and where we've been this far. So we're excited to reach out to whether you're looking to invest personally or through a corporation, how we can make a high yielding, tax efficient investment for you.
Fantastic. And Ara, anything to add there before we
Well,
So
I love what you guys are doing, and I love Canada, and we believe in Canada, and from even before Trump came into power, we've been promoting investing in small businesses and Canadian businesses, and there are so many advantages to do that. You know, the tax regime really incentivizes you to, and we are behind past 10 years in our GDP because we just simply invest less. So there is a chart out there that compares US investment into businesses versus Canadian. And surprise, surprise, they invest more in their own businesses. So I'm glad we're doing this. And I'm glad what's happening in the market because people are waking up and we have an amazing country, amazing entrepreneurs. And like Simon said, they're retiring. So they're going to need some amazing people to take over and unlock the future of Canada. So I'm very excited. So and I thank you guys for what you're doing.
Thank you again. Thanks,
Thank
both of you.
Thank you. Thank you both for being here. Just as a reminder here, folks, if you want to dig in, head on over to pe-gate.com to learn more about the offers and the platform from PE Gate. Head on over to CanadianWealthSecrets.com/pathways if you want to learn more about how we structure the 4 stages for a healthy wealth system, whether it's in your personal wealth system or your corporate wealth system. You can take our assessment there, our free assessment, and get a report that gives you some next steps on structuring your wealth planning journey. So pegate.com or CanadianWealthSecrets.com/pathways. Thanks again for joining us here in this special joint webinar, and we'll be seeing you soon. Just as a final reminder, the information you heard here today is for educational purposes only. Should not construe this as financial advice. That financial advisor that you hold dear. Take care, everyone.
Thank you.
see you, everyone.